Member for Wills.
Thank you, Deputy Speaker. The purpose of this bill is to repeal some of the future of financial advice measures introduced by the Labor government. The bill amends the Corporations Act to remove the need for clients to renew their ongoing fee arrangement with their advisor every 2 years, which is known as the opt-in requirement, to make the requirement for advisors to provide a fee disclosure statement applicable only to those clients who entered into their arrangement after the 1st of July 2013, to remove from the list of steps an advisor may take in order to satisfy the best interests obligation the requirement that advisors must generally act and provide advice in the best interests of their clients, which is referred to as the catch-all provision, to facilitate the provision of advice limited to, say, a particular product or product range, that is personal advice that is limited in scope, and to provide an exemption from the ban on conflicted remuneration for general advice but not personal advice in certain circumstances. Broadly, personal advice is advice directed at a person by an advisor with knowledge of the person's objectives, financial situation and/or needs. General advice is advice that isn't personal advice. This Liberal government has a penchant for the euphemism, whether it's green tape, open for business, or in this case, streamlining. What in fact is happening here, however, is yet another example of the government bowing to the vested interests of the big end of town. Labor's reforms, referred to as the FOFA reforms, were introduced for a reason. They were introduced in the wake of the collapses of Storm Financial and others, and the subsequent parliamentary inquiry into financial advice, products and services. These were the most significant reforms in financial services for a generation, and they include a number of measures designed to protect investors and to help the industry become more professional. They included the best interest duty, requiring advisors to act in their clients' best interest, the opt-in, requiring advisors to get their clients to opt in to receiving ongoing service every 2 years, annual disclosure, statements to be sent to clients annually disclosing fees and details of services performed, and a ban on conflicted remuneration, that is, commissions paid by financial product providers to financial advisors. Now, the whole basis for introducing these FOFA reforms was to restore faith in a sector which had been rocked by high-profile collapses, a poor culture of product sales over advice, and now that we have $1.8 trillion in savings, to ensure that Australians are getting advice and service that is in their best interests. During the reform process over many years, there was extensive and intensive industry and public consultation that clearly identified a path to achieve growth, to protect consumers and restore trust by changing the culture of the past 20 years, lifting standards and professionalism and acting in clients' best interests. Now, the government's comments on their changes, these changes to FOFA, are about certainty for the sector but not for the consumer. The changes are much more than technical reforms. They are a complete unwinding of FOFA. The lowering of standards and the delay towards professionalisation is a massive step backwards for the entire sector and for consumers. Removing blanket best interests, well, this is what the banks want. This has nothing to do with red tape and everything to do with the government doing the bank's bidding. It is not about protecting ordinary people. Deputy Speaker, the effects of recent major financial advice scandals have been catastrophic, resulting in consumers losing $5.7 billion in funds, losing their homes, losing their financial security in retirement. And as the Consumer Group Choice has pointed out, and so too did the member for Moreton, the proposed changes will lead to costs to consumers as they reintroduce measures that encourage sales-driven practices in financial advice. With financial advisors working in boiler room-style sales cultures, consumers are highly likely to lose significant funds through further major market failures like Storm Financial. While no legislation can fully prevent a market failure, the original FOFA reforms aimed to curb the worst practices in the financial advice industry. Now, Deputy Speaker, I know firsthand from my electorate of Wills constituents have been affected very badly as a result of poor advice by a financial advisor. specifically the Melbourne-based accountants and financial planners Holt, Norman, Ashman and Baker. People have lost their homes, hundreds of thousands of dollars, their self-managed super funds, their share portfolios and their health because of poor advice and management by Holt, Norman, Ashman accountants. Deputy Speaker, Mr Holt sold schemes using dubious advice concerning loans and using margin lending. An example of the consequences of his poor advice is contained in the following impact statement provided to me from constituents. And they said, "Our situation has been desperate since October 2008 and very much a work in progress, looking for the bottom of the financial quagmire, the legacy left by Mr Peter Raymond Holt, our ex-accountant. In brief, Mr Holt had overcommitted us with debt by taking out loans in tree schemes, Timber Corp. We were unaware of most of these loans and they were for large sums of money. He had been paying them with money from a bank account that was to collect dividends from my husband's margin loan account. I found the deductions in the margin account in October 2008. The amounts were very large and would eventually bankrupt us. The first invoices that we received from Timber Corp were forwarded to us by Holt's office in October 2008. They were to the value of $128,000 and were due for payment on the 31st of October 2008. It was about then that we really came to grips with the true meaning of debilitating and hysteria. Hell had begun. By the end of January 2009, our situation was dire. Holt had lost $70,000 in cash trying to save margin loans with stupid recommendations. He had turned about $450,000 cash into $15,000 with margin lending. We had deductions of about $177,000 per annum for tree schemes. These payments would exceed our income for the year. Peter Holt has gone through hundreds and hundreds of thousands of dollars, including our superannuation fund. We really don't know the exact tally, but it would be somewhere around $400,000. The deeper we dug, the worse things got, so we stopped digging. And Deputy Speaker, as a result of the efforts of the Holt, Norman, Ashman, Baker or HNAB Action Group, set up by past clients who were financially ruined by Mr Holt, a group dedicated to providing information to members of our community who've been victims of poor financial advice, ASIC banned Peter Holt for 3 years. In my view, this was pretty light. I think his actions warranted a life ban. Peter Holt filed for personal bankruptcy and his personal assets seem to have been largely protected through his bankruptcy proceedings. Two of the partners of the former firm now operate as an accountancy practice called Holt Baker Proprietary Limited, and the financial planning arm of the practice is called HBM Advisors Proprietary Limited under the Wealthshore banner. Peter Holt and his associates were the largest distributors of the Timber Corp product. Peter Holt and his associates geared his clients in share portfolios and managed investment schemes including Timber Corp and other agribusinesses. His clients in many cases were not aware of the agribusiness loans, and in particular the loan conditions were either misrepresented or not disclosed at all. These loans effectively resulted in some clients being geared twice over. Where gearing was disclosed, he assured his clients the margin loans would never exceed 50%. Investors were explicitly assured their homes were safe. He in fact allowed the margin loans to exceed over 200%, resulting in his clients losing their entire share portfolio and other assets. Former clients have made attempts to recover their capital losses, which were significant, but there was inadequate professional indemnity insurance that was only $2 million. According to the HNAB Action Group, significant flaws exist in the practices used by Peter Holt and his associates. He frequently assured clients that he was ex-ATO and represented the investments as government-endorsed and a superior investment than superannuation. In most instances, clients were just asked to sign the rear page, which were not witnessed in their presence. Asset, liability and income details were often left blank or were completed after the client had signed the application. Some of the loan documents recently obtained from Timber Corp Finance show that these details were never completed or had liability details erased or included incorrect client information. Timber Corp management, maintenance, insurance fees and other agribusiness fees were disguised by being rolled into refinancing of debt. Timber Corp increased the level of commission paid to financial advisors to promote their geared investments as the GFC began to impact. A number of clients were pressured by Peter Holt and Associates to increase their level of investment in Timber Corp even when the product was failing. Undisclosed incentives were provided in relation to his recommending of Timber Corp products, for instance the provision of overseas trips. Given that the product disclosure statement for Timber Corp required them to disclose all incentives they might pay to advisors distributing their products, this would have been in breach of the requirements of the Corporations Act. And even when gearing levels were significantly above the 50% threshold on margin lending in share portfolios, which he'd set as the maximum, as the GFC set in, he continued to recommend and pressure clients to continue to increase their gearing by buying more Timber Corp or other agribusiness products. Now, Deputy Speaker, as recommended by the HNAB Action Group, ASIC should be requested to reopen the case against Peter Holt and his associates with a view to a life ban. A 3-year ban is inadequate, and in any case it is alleged that he is circumventing the ban through the engagement of an authorised representative working from his accountancy practice. The significant omissions and potential fraud in respect to loan documentation should be investigated and all debts frozen and recovery actions ceased by the respective creditors. ANZ, CBA, Macquarie Bank and other credit providers should explain their involvement, explain why such significant breaches of lending practices were permitted, and they should waive debts as a consequence of the improper and inappropriate lending facilitated by Peter Holt and his associates. And furthermore, Deputy Speaker, the proposed changes to the FOFA reforms that we're debating now should be opposed due to the risk that loopholes are reopened which enable advice scandals like this one to occur again. There needs to be opposition to the bill's removal of the opt-in requirement, that is, the requirement for financial advisors to obtain their clients' approval at least every 2 years to continue an ongoing fee arrangement. This has been criticised by National Seniors Australia, and I quote, "Removing the opt-in requirement pushes the obligation onto consumers to externally monitor the performance of their portfolio and the appropriateness of their current services and fee structure. It is clear that advisors are far better equipped than customers are to perform this task. Without the opt-in requirement, most consumers will remain inactive, unaware of the services they are receiving and the associated fees and charges. They will not have the opportunity to determine if they are receiving value for money." CPA Australia and the Institute of Chartered Accountants also support the existing mandatory 2-year opt-in process as an important pillar of the FOFA reforms on the ground that it will assist clients who are actively involved in planning their financial future to assess whether the services they are receiving reflect value for money before they decide to renew an ongoing fee arrangement. Now, the Minister says that people who are opposed to their changes are vested interests with political motivations. Is the Minister seriously saying that the National Seniors or the Council of the Ageing or Choice are part of some Labor union conspiracy? Despite a Senate inquiry into these changes and revelations about disturbing poor practice at the financial planning arms of the Commonwealth Bank, the Liberal government is pushing ahead with these changes that clearly put the big banks' interests ahead of those of consumers. These changes have nothing to do with removing red tape or streamlining and everything to do with the Liberal government acting on behalf of vested interests in the sector. The CBA crisis highlights the problems that can arise when people try to push products when they're supposed to be offering consumers independent advice in their best interests. The proposed government changes are not minor or technical in nature. They are rather a complete undermining of the core principles of consumer protection and lifting standards to a professional level. The reality is that these changes will broaden the scope of what banks can do in terms of upselling and advice and products to make more money. That's the reality of what's being done, and if these changes pass, people will need again to pay a lot of attention, close attention, to the type of advice they are getting. It is entirely regrettable that the Liberal government has decided to weaken the strong elements of consumer protection put in place by the previous Labor government.
Order. The question is that this bill be now read a second time. I call the member for Griffith.
Thank you, Deputy Speaker. Deputy Speaker, as you know, in 1969, Gough Whitlam, in his pitch to the electors of Australia, talked about the importance of consumer protection as being central to part of Labor's platform and Labor's program. And again, in the lead-up to the election at which he was elected, he talked about consumer protection, and as a consequence, we got the Trade Practices Act in 1974. And I make those comments because it's important to remember that Labor has always been the party of consumer protection. Labor has always been the party of saying there are plenty of interests in our community. How about the interests of consumers when it comes to weighing the protections that can be offered? And what do you see many years later, Deputy Speaker? Labor's FOFA reform